Yields are up, stocks are up. Live from New York City this morning. Good morning, good morning. The S&P up by 0.6%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Ferro.
Live from New York City, we begin with the big issue. Fed officials pushing back.
They essentially just reiterated the message they've been trying to send.
The pivot that everybody's talking about.
It's just too early.
Core headline, CPI, PCE, whatever. It's all some huge number.
The Fed is actively trying to be hawkish.
Powell really endorsed this message of data dependence.
Seemingly quite a dovish tone and rhetoric.
I don't necessarily think they were that dovish.
Now we're actually having Fed speakers come out, be quite hawkish.
Evans coming out and others saying, no. We're still really focused on inflation.
I think it really did catch markets somewhat off guard.
We're going to have this fast and furious data rush.
To come out and explicitly signal something new.
It's too early.
The market is looking for a pivot.
We don't see it.
This was not a pivot from the Fed.
Joining us now, Tallbacken's Michael Purvis, Eric Knudsen of Neuberger Berman. Eric, is this enough, this pushback from this Fed, enough to bring the bond bear market back to life?
I think they're going to need to do some more work, as was mentioned yesterday. You've seen real yields, which were at negative 1% at the start of the year and did rise up to 0.7, 0.8, which felt reasonable in terms of the level of tightening that was needed to calm inflation over the long term. Post the Fed meeting, go back down to 0.1, very accommodative levels. They're now up 30, up to 0.3. Probably need to, see those at the 0.5, 0.6, 0.7 level again to begin to really tighten conditions sufficiently to get inflation under control.
Michael Purvis, we've been absolutely whipsawed in this bond market. The two-year yield on Wednesday, when Chairman Powell spoke, went from about 3.05% down to 2.99. The day after that, it plunged by about 13 basis points after GDP. Yesterday, it popped by 18 basis points. In your opinion, Michael, was this a communication failure or an interpretation failure after Chairman Powell spoke last Wednesday?
It seems like it's a little bit of both. Look, I think, just following up on Eric's point, you saw after the FOMC, you saw nominal yields coming in below a key technical level with break-evens going higher there. And I think it was really the break-even story that the Fed had to react to this week, saying, hey, wait a second, we don't really need 10-year real rates back into negative territory. And it really looked like that was going to happen. If you just look from a technical chart point of view, that 10-year yield, you can see 2.5, even 2.25 there. And if break-evens even just hung there, you'd get real interest rates back into substantially negative territory. And so if the Fed is a gamble. Like if they're going to look at, well, what if the next CPI print has a 9 handle on it, right? They're going to look like they've really screwed up there. So I think there's no question the Fed had to aggressively come out this week to say, hey, wait a second, guys, let's not get too comfortable, and we're not back to sort of the pre-COVID era type of Fed policy.
This is what I don't understand, though, Eric. What Michael just said, everyone was saying it over the last 3 days. They were lining up on this program, on surveillance with Tom Lisa and I, to say the same thing, that the Fed would have to push back, yields were going higher. Why was this market like a cold spring going into Fed speak that we were all waiting for? Why were we so surprised by yesterday's comments?
Well, I think that we're in an unprecedented territory in many of our investing lifetimes. And I think that's what's creating so much confusion and uncertainty. We're in a world where real growth could be negative and nominal growth is 7, 8, 9%. As I said, in most of our investment lifetimes, we have not seen an environment where nominal and real growth was that different. And I think many of us are struggling to think about how to play this in our models. Are we playing tightening financial conditions? Are we playing slowing growth? But maybe slowing growth doesn't have the same impact on EPS it did because we're in a very, very different nominal world. And what that's doing is that's pushing outcomes into the tails of the distribution instead of being in more normal parts of the distribution. And I think we're going to continue to see this volatility.
We're in a different world in the oil market as well. I'll just bring you an update on what's happening with crude at the moment. We are higher by about 1 percentage point on Brent to 101.53, on WTI by 1.15% to 95.51. A couple of hours ago, we had the smallest increase in OPEC plus output in its history of just 100,000 barrels a day. This is what OPEC has got to say at the moment. Chronic underinvestment has led to low spare capacity. They are severely limited when it comes to spare capacity, and that spare capacity must be used cautiously. I'll catch up with Gillian Lee in about 20 minutes from now, and Anne-Marie down in DC, because we all want to hear what the White House response to this actually is. As we look at this market, the equity market, futures positive, about 25 minutes away from the opening bell. We've heard a tenor Fed speak. Unleashing that move higher in yields was this person right here, the San Francisco Fed President, Mary Daly.
Oh, nowhere near almost done. We have made good start, and I feel really pleased with where we've gotten to by this point. But let's just remember the last numbers on inflation, 9.1%. Those are far too high. People are starting to think that the economy is downshifting. But we can't stop there. And it really would be premature to unwind all of that and say the job is done.
Mike McKee, the job is not done.
Nope. And the way you've been talking this morning, John, you just got me thinking about the movie Cool Hand Luke. Did you ever see that movie?
I did watch that.
Paul Newman?
Is that when he consumed a lot of eggs?
One of the most famous lines in movie history. And you take a look at where we are with what the market expectations are for the Fed over the next 6 to 12 months. And all I can think of is what we have here is a failure to communicate. The market thinks the Fed is going to cut rates, and that basically kind of comes out of the fact that the economy has slowed a bit, and then you had Jay Powell saying we were near neutral, but as you heard, Mary Daly yesterday, Charlie Evans, the Cleveland Fed President Loretta Mester, and Jim Bullard all saying, no, we're not there, and we're not going there yet. And here's something that Bullard has pointed to in the last 2 days, and that's the Dallas Fed Trim Mean CPI number. He said he likes this one because you take off the top most movers and the bottom most movers, and you get the middle. And as he pointed out, it's over 4%, and it is not showing any signs of rolling over. So their job is not done. And he went on to say, as have others, that no, we're not at neutral yet. And on an effective basis, we're right below it. But they think they're going to have to go above that to bring down inflation. In fact, Bullard thinks we may need to go as high as 4% to get it down. So the Fed's work is not done, and they're trying to make that clear to people. Wishful thinking on the part of Wall Street isn't going to make the Fed react.
We had a lot of wishful thinking over the last week. Mike McKee, thank you. Looking forward to a ton of Fed speak through today as well. Mike's going to drop by again in about 30 minutes' time to go through some PMI data. Then the ISM services number comes out in about 53 minutes or so. Yields are higher again by 5 basis points on a 2-year at about 3.1%. Yesterday, higher by 18 basis points. What was interesting about yesterday to me, if I told you up front today we'll have an 18 basis point move on a 2-year and the Nasdaq would fall by just 0.16%. I wonder how many of you would believe that. Michael Purvis, that raises a big question. What do you make of how the bond market's taken this down, one, and two, how the equity market hasn't really responded to it?
Look, on the bond market side, and I think this is very much connected to sort of the equity market reaction here, is that, you know, the terminal rate has moved, the timing of the peak terminal, the peak rate in the cycle has moved from December 23 to September 23 to April 23 and now to really the end of this year. And even if that rate gets higher, the closer it gets is really, really important, I think, to the equity markets, right? You know, in other words, the brighter the light is at the end of the tunnel, the closer that terminal rate is perceived to be. But I think Michael McKee's points about, you know, hey, you know, why is the scale of cuts next year priced in? Like, where is that really coming from? And is that a healthy, condition or a stable condition? I think is a really, really important question there, and really one of the things that's sort of really undermining or underscoring so much of this sustained rate volatility. But as it relates to equities, look, if we are getting to the point where we can actually sort of really get to a sense that we are seeing sort of, the terminal rate, triangulate on that to some level, and that we don't know what the future of the rate hikes after that is, but we're past like peak, Fed hawkishness in terms of like, these sudden, surges higher in pivoting and in rate expectations, and earnings are cranking away. This season so far has been, again, one more, really pretty good season. And I continue to be sort of an earnings bull here, you're going to start seeing equities get supported. I don't know I'm very skeptical as to how far the NASDAQ can really rally to, just simply based on my measurements of equity risk premium and such. But, do we have to get to 3,400 on the S&P 500? Well, I think that requires a different set of facts to start really showing up. And that really means recessionary dynamics. And we're not seeing those just yet.
Futures right now up 0.6% on the S&P. Maybe Marko Kolanovic is right over at JP Morgan. Eric, maybe he's right. We've seen the worst of it. BNP Paribas think perhaps we could get some crowding in. This is what they have to say. With the Fed laying the foundation for a more moderate approach in the back half of the year, alongside resilient earnings, they go on. We see scope for further upside in the near term as market participants get crowded in. Eric, does that resonate with you?
Absolutely. As we think there is potential for another leg higher in the short term rally. We still think it is a bear market rally, and that we're going to revisit lows, if not see somewhat lower lows in the 3,400 to 3,600 range. But I think many investors were expecting earnings to come in not just weaker in the quarter, because I think people thought that there'd still be a reasonably good earnings season, but that forecasts and guidance would be marked down significantly more than they have been. And I think this is getting to that difference between real and nominal. Everybody's thinking, we're going to slowing growth, going into recession. That means earnings should be down on in our real world, in our last 20 years reference, 15, 20% or more. But in fact, in the nominal world, where corporations are earning and revenues and earnings in nominal terms and still able to pass on a fair amount of that to consumers, earnings may not be down that much, even in a slowing real growth environment. And I think some of that is changing the pricing, including in NASDAQ, which you would expect to be more damaged by the rising rates in the short term. So as investors recalibrate this kind of expectation around earnings, you could see another move higher here. And then you're going to have to deal with the fact that financial conditions need to tighten again. And I think that's going to cause another potential leg down in equity markets.
And nominal GDP speaks to exactly that. Eric Knudsen and Michael Purvis, thank you, gents. Futures right now up 0.6% or so. Let's get you some movers. We can do that with Abby.
John, well, lots of big names to take a look at on the move this morning, starting out with AMD, the world's second largest maker of computer processors. Well, it is down. This after a little bit of a miss in the last quarter and weak guidance for the third quarter. The company is seeing a little bit of weaker demand for computers. Airbnb also slumping, this as they put up what's being considered a mixed quarter. The third quarter, though, the guidance a little bit soft, and this has to do possibly with a pullback from the post-pandemic demand boom. PayPal, on the other hand, surging up 13%, a very strong liking the idea that Elliott is such a large holder, and the tough love, they're saving $900 million. So those cost savings investors really liking. And then finally, Meta. Well, this is really interesting, John, because, of course, Apple earlier this week issuing $5.5 billion worth of bonds over 4 offerings, tranches. And you can see Meta up 2.4%. They've never done a bond offering, but they're considering it. They're meeting with some of the major banks today about this possibility. They have $50 billion worth of capacity, but it's probably $10 billion. So perhaps another big tech bond offering is ahead, John.
Abby, thank you. Coming up on this program, we take it to Vienna. OPEC Plus agreeing to the smallest production hike in its history.
It's hard to overstate how disappointing this OPEC Plus decision is for the Biden administration. Yeah, frankly, it's the geopolitical equivalent of a slap in the face.
That conversation up next.
Yen energy markets are tight and will remain tight and volatile.
The thing that's exercising every airline's chief executive at the moment is oil price.
Brent oil will be above $100 per barrel.
That's the single biggest cost in terms of fuel. And at the moment, there's probably risk in that going forward.
Where we are today, there is more upside than downside.
What we do see is continued volatility and very tight markets going forward.
OPEC Plus has just delivered one of its smallest oil production increases ever in its history at 100,000 barrels a day. From New York City this morning, good morning. I'm pleased to say in D.C., this will teach a policymaker never walk past Anne-Marie's camera because she'll snag you, put a mic on you and put you in front of a camera. Right now, we're joined by the US State Department Senior Advisor for Energy Security, Amos Hochstein. Amos, great to catch up with you, sir. Fantastic morning for it. So let's start right here. Your reaction to what we just got from Vienna an hour ago.
Well, first, thank you very much for having me, and it's good to be with everybody this morning. Look, today we continue the same policy. We're at 50. This is the 50th day that gasoline prices are down in the United States. We were about $5, over $5 about 6 weeks ago, and today most Americans are seeing gasoline prices that are below $4. Prices at oil markets, oil prices were at about $120 a barrel about 6 weeks ago. And today we're at about $95, $96 here in the United States. So that's a $22, $23 decline in oil prices in 6 weeks. That's remarkable. And so the president wanted to see oil prices down, wanted to see gasoline prices at the pump down. That's what we're seeing. And I think what's very remarkable here is that we're seeing that happen while one of the largest oil producers in the world is in the middle of a war in Europe and is under sanctions. So this is not an easy time to manage energy markets. We want to see lower prices. These are lower, but not low enough, and we're going to continue to try to do that.
I'd like your understanding of what you think happened in Vienna specifically. BTIG and Isaac Boltanski in the previous hour was on Bloomberg Surveillance with us, Amos, and he called this, quote, the geopolitical equivalent of a slap in the face. Is it a geopolitical equivalent of a slap in the face of this administration after that meeting between the Crown Prince and the United States President?
Well, as you know, that the OPEC decision just about a week before the president traveled to Saudi Arabia, they announced the increase in production in July and August. Yesterday, I believe your network published that Saudi Arabia had increased production at remarkable levels in July. So, no, look, the president went to Saudi Arabia not about oil. Energy was clearly a very important topic. But think about what happened on that trip. The president was able to save thousands of lives by extending the ceasefire in Yemen. So after 7 years of people dying on a daily basis, we now had 16 weeks of a ceasefire. And yesterday we announced the extension of that by another few months. Israel is more integrated into the Middle East, and we have a more stable Middle East than we had when we inherited and came into office. At the same time, oil prices were at $120 6 weeks ago when we announced the trip. Look where they are today. So the importance that the president has is not discussing barrels with any country. He has been very clear that he wants to see oil prices come down and he wants to see gasoline prices come down. Both are down and not enough. It's not just a global issue. You've seen just a week ago the results, the second quarter results of oil companies in the United States and around the world. They were record profits. What we want to see is those record profits that have come on the back of the consumers be invested back to increase production here in the United States as well. So we're calling on, whether it's OPEC or it's here at home, to increase production when possible and at the degree that it is necessary to keep these prices coming down. And I think we've been able to achieve exactly that.
Amos, as you know, for them to make those long-term investments with confidence, they need policy continuity. How can that be guaranteed to them at the same time as a conversation is ongoing about ending their activities full stop completely? You understand the difficulty around that story. How do we promise these producers any kind of policy continuity over the next decade, the next 2 decades?
Well, let's if we put away all the hyperbole from the industry a little bit, let's look at this for real. Here in the United States, most of the production that we're talking about increases is onshore in the United States. Those are short cycle productions that don't need 10 and 20 years of investment certainty in order to be able to make profits. At these oil prices today, They can invest those dollars today and get the profits that they need and give the relief for the American economy and the American people. We know that. Second, we're in the middle of a transition. We want to see declining demand for oil over the medium and long run, and that's what we're trying to do. That's why we're trying to accelerate electric vehicles. But you and I both know that that's going to take the time. And so we need to do two things at the same time. We need to make those investments today in order to have enough of the energy resources that the American economy and the global economy needs while we accelerate electric vehicles and renewable energy. Demand for energy is growing at a remarkable and unexpected. Nobody thought it would rise this quickly after COVID. Think about where we were a year ago with Omicron threatening to shut down the global economy again, and it didn't. And now we are at a post-COVID remarkable demand for energy, and we need to meet it. And we need to invest into our future as well.
Well, Amos, I wonder how we can meet that in the shorter term. And I think this right now is the big issue. You've taken a lot out of the SPR. OPEC Plus this morning is saying we're severely limited when it comes to spare capacity, and it must be used cautiously. We've seen chronic underinvestment. It's led to low spare capacity. Do you have a deep understanding of how much spare capacity the world has right now, Amos, and the risk around that story? And I think it's something we've all got to recognize going forward from here.
Well, I think that we absolutely need to be focused on that, and I can assure you that we are. And that's why I keep saying this is not focused on OPEC. This is a global issue that also has impacts here in the United States, and that's why the president has consistently called on the industry here in the United States to increase capacity. They do have the capacity to increase. There's no doubt about that. The idea that a company in this environment that you just described would buy back shares and not invest it into additional production, that would buy back shares and increase dividends and not invest into ensuring that we have more refining capacity, bring back some of the refineries that were idle during COVID. That's what we should be focused on. The president has told the industry, we're willing to work with you. And I think I say that again today. We're willing to work with the industry to increase production, to increase refining capacity, and to make sure that we have enough production for the American public.
Amos.
At the same time, you can't deny the fact that prices are significantly down over the last 6 weeks, and that is something that we want to continue to see happening for the weeks to come.
You're speaking about private companies making decisions that they think is best for their investor base. That's capitalism. At the same time, you're describing what you would like to see from a public utility. Well, that's a sovereign state, and we can talk about sovereign states making those decisions today. They're not making those decisions to boost output. Now, can you take me into the room with the Crown Prince Mohammed bin Salman? And you said that meeting wasn't just about that. I want to understand what your expectations are now from the kingdom on oil output and whether they were met this morning off the back of that very short meeting from this cartel.
Well, to be honest, we did not really discuss oil markets in that meeting. We had far more pressing issues to discuss. We obviously discussed energy as part of it, but it wasn't the lion's share of the meeting. As far as what they did today, look, I will say this again, I am concerned that oil prices continue their trajectory of going down and maintain the stability in the markets as we are continuing to follow developments in Europe in the war and the invasion of Russia and the remarkable impact that it's had on the global oil market. So this is not just about spare capacity, it's also about what's happening as a result of the war. I want to see that OPEC, our expectations are that OPEC will continue to increase production and meet every month to decide what it needs to do to maintain adequate supply on the market. I'm looking at the price today. I'm looking at the price not just on an hour-by-hour basis, but as we broaden that aperture. Over the last couple of months, we've seen the oil markets react in the way that I wanted, but it's not enough, and we want to see more. So we have the decision today to continue increases that, quite frankly, were supposed to go to zero, and we'll see at the meeting next month where the market is and what OPEC does then. And we will continue to have the same message, whether it's a sovereign or if it's a private company. This is the time, if you have the capacity, to invest in it and to be able to make sure that the global economy has what it needs to continue to grow. Because if it doesn't, both the sovereigns and the private companies will suffer the consequences as well. And most importantly, the American people will. And that's not what we want to see.
Amos, you can see why some people are frustrated by the rhetoric. The administration has been very keen to go after the domestic producers, and quite aggressively so. Yet when we talk about OPEC Plus, we kind of tiptoe around the story a little bit, and I'll allow you to jump in on that in a moment. I just wanted to share this stat with our audience and with you as well. Julian Lee here at Bloomberg has broken down this 100,000 barrel a day increase today. Shared pro rata across OPEC Plus members, it would raise Saudi Arabia's target by 26,000 barrels a day, not even enough to fill one Suezmax tanker a month. Amos, why the harsh rhetoric on private companies in America and not a harder line with the Crown Prince and the Kingdom?
In fact, I don't think I've had any harsh rhetoric at all. I'm saying that I would think that producers in the United States should invest more. We've been meeting with them. I talk to them all the time. I don't think that that's harsh rhetoric. In fact, I think that if you listen to the comments by some of the CEOs of the major U.S. producers, they themselves over the last several weeks have said that they intend to increase production and to invest in additional capex. So I think that as long as they do that, we're on the same page. When it comes to OPEC, I've said it clearly. I think that we wanted to see additional increases. We saw that at the beginning of June for July and August. We saw the numbers that you published yesterday at Bloomberg, where Saudi Arabia had increased production in July. They're going to continue the increases in September. Whether or not it's adequate, we'll find out as we continue to monitor the oil markets. We expect producers, whether they're sovereign or private, we have the same expectation that they increase production where their capacity allows it, and to support global economy to continue to grow and to make sure that the price of oil allows that. That's what we want, and I don't see any difference between the two.
I wanted to get to the final topic, and thank you for your time this morning again, on the oil cap, on Russian prices of Russian oil. How's that working out, Amos, and is anyone else on board when it comes to the likes of China and India?
Well, I think what we would like to see is to see continued supplies on the market. We're not trying to reduce the number of Russian barrels on the market. We're trying to reduce and to cap their revenues. And we already know that they're open to that. They're selling their oil today at significant discounts on the market already. We've worked with the G7 allies. We were in Europe last week discussing it with some countries as well, and we continue those discussions. As far as other countries joining, I think we're still putting the mechanism together and discussing it with other countries.
Does it work if you don't have the likes of China and India on board? Amos, just from me sitting here listening to this, how it's played out over the last few months, I just don't see how it works without those two countries on board. How does it work?
Well, I think, John, that whether they join formally or not, at the end of the day, if countries are buying Russian crude at significant discounts, I'll let you decide if that's working or not.
Amos Hochstein. Amos, thank you. Run away from Anne-Marie in future. Then you want to get dragged in front of a TV camera to catch up with me. Amos Hochstein there, of the administration, off the back of this decision from OPEC Plus. Just 100,000 barrels a day for September is the smallest hike in its history. And you've heard what others are saying about this. BTIG called it a geopolitical equivalent of a slap in the face. Amos Hochstein just moments ago saying that that meeting with the Crown Prince, Mohammed bin Salman, in the last month was not about oil. This is what the market looks like around the opening bell. Equities up by 0.5% on futures on the S&P. On Nasdaq 100 futures up by around about 0.6%. On the Russell there, up by 0.75%. Equities elevated. If you switch up the board and get to the bond market, I'm going to take a look at yields for you. Yields higher by about 3 basis points on a 10-year to 278.29, 278.11 at the moment. Euro dollar positive by about 0.1%. Crude just slightly negative. We turn around again. We're down by about 0.1%, 94.28. A ton to talk about in this commodity market. Let's get you to the opening bell, though, and get you some movers. Here's Abby.
John, well, one stock certainly contributing to the bullish tone that we have this morning. PayPal, the stock is surging after they put up a solid earnings report, but it's really the composition of the beat. They beat earnings by 6%, and that has to do with cost-cutting savings on the year of about $900 million, expected to be $1.3 billion next year. They also announced that Elliott Management is a major stakeholder, and some analysts are calling it that firm's tough love that is really helping out PayPal. So you can see investors really cheering that on. Devon Energy up just a little bit in the wake of this OPEC plus increase, the smallest in history, as you've been talking about, or one of the smallest, now flipping slightly lower, in line with oil, basically about unchanged as well. But just wanted to check in on that sector. Wells Fargo up 1%. Interestingly, yesterday when yields surged so much, that 2-year yield up nearly 20 basis points, the bank had been down about 1.5% in that sector weaker, but today a bit of a bounce back. And then finally, Ford up 3.1%. They reported July sales that are very strong, including trucks and EVs up 36.6%, the total U.S. vehicle sales, and very strong on the EV side too, John. So you can see investors rewarding the shares of Ford.
Abby, thank you. Earnings very much in focus. We are positive 2 minutes in by 0.5%, up 0.8% on the Nasdaq. Pretty amazing what we've seen in the Nasdaq over the last week. In fact, the last 2 days, given what's been happening with Treasury yields. Yields are much higher, and the Nasdaq looking more and more resilient by the day. On the earnings front, 70% into earnings season here in the United States, with the latest results out from Under Armour cutting its profit forecast. Let's get the latest with Taylor Riggs. Hey, Taylor.
And John, I think what's interesting, and I'll let you decide how much we've been cutting estimates coming into this earnings season, but I guess the positive news is that about 74% of the companies so far that have reported are actually reporting a beat here on the bottom line, and maybe more better forward-looking guidance. About 34% of those companies are also guiding higher in terms of the bottom line as well, though about 30% guiding lower. Again, though, the big question here is how much had we really cut some of these estimates coming into this earnings season. What goes for the year goes for the earnings season. Energy, utilities, of course, the best performers on a price basis on the S&P 500, and also sort of the best performance in terms of actually the top line surprise here. Maybe showing some of the pricing power and whatnot, at least when we think about some of the inflationary environments underway and the top line translation of that. As we think about going forward, what's left, about a fifth now of the S&P 500 in terms of value is left to report. You still do have a lot of tech, some healthcare, maybe some discretionary. I know Walmart's in there, Home Depot, Eli Lilly, NVIDIA. Of course, as we think about sort of some of the chip makers and the ramifications after AMD yesterday. So that will be a big, again, sort of checkpost, signpost here going forward.
Taylor Riggs, thank you. Look out for Taylor a little bit later on a closing bout with the team, of course. The focus for so many people is that we just haven't seen the cuts to earnings estimates. Bank of America on board with this. This is what Savita Subramanian has to say. We're still in the very early innings of the downturn, and estimate cuts too. Was June the big low? Our bull market signposts say no. Kelly Lyons has more. Hey, Kaylee.
Hey, John. Yeah, it's all about that forward view because, as Taylor said, the second quarter looks like it actually was okay in terms of earnings, but that's backwards looking. So the question is, the rally we have seen since earnings season started up about 8% on the S&P 500. Can that continue if the picture looking into the future is a little bit more cloudy? Of course, second quarter earnings estimates since earnings season has started really over the last 3 months have actually risen by about 1.7%. But when you look at that forward view, we've seen revisions downward for the third quarter, the fourth quarter, and the first quarter of next year to the tune of about 3.3% for the current period we are in now. And while those projections have fallen, they're actually still about 6% higher than they were when the market was at record highs back in January. And Bank of America, which you just referenced, says that in the past 4 recessions, the S&P 500 has only bottomed after EPS forecasts have fallen either to or below the level they were at when the market last peaked. So clearly, we are not at that level yet, and there's plenty others on the street warning about more to come. Mike Wilson at Morgan Stanley has been ringing that bell for some time. He says the magnitude of cuts are just too modest so far, and he expects things are going to get worse as the economy deteriorates. He thinks the bulk of the cuts will be coming in the fourth quarter of this year, and just today, RBC Lori Halvacina joining him in that, saying in the second half we could see more cuts coming.
This is the worry hanging over the market, and Kelly, thank you, is that the earnings are too resilient and the cuts are still to come. That's the reality at the moment for a lot of people worried about the future. This is what RBC's got to say. Kelly mentioned Lori Calvacina. The rally in stocks is fragile, given the possibility of further downward revisions to earnings as 23 comes into view. Well, the downward shift is what investors had been hoping for. The magnitude of the declines doesn't match up in our minds with the idea that a recession is starting or is on the horizon. Lori, I'm pleased to say, joins us right now. Lori, your language, we just haven't ripped off the Band-Aid, have we?
We haven't. And, it's funny, John, I spent a lot of time on the road coming into this reporting season, and that's what I heard meeting after meeting. We've got to rip off the Band-Aid. We want one big cut. We don't want to drag this out. That's what investors wanted to see. And we're looking at 2022 forecasts for the full year that have come down $1. We've looked at next year's numbers that have come down by a couple bucks. And so we're left here in a position saying, okay, either the Band-Aid doesn't need to be ripped off or it's still got to be ripped off later this year. I'm inclined to think that perhaps, I'm not quite as bearish as Mike, but I do think that we do need to see a bit more downside. We've modeled out what we think the current macro is forecasting for this year and next. We come up with 214 for this year, 212 for next year. So even if we're too conservative, we still think there's some more froth that needs to come out. And even if we did see the lows in June, it's possible we could go back down and retest them, or we could simply stay volatile until we get this issue resolved. But I just find it very, very interesting that the market has rallied so strongly when investors are getting exactly the opposite of what they said they wanted.
Hey, Laurie, it's doing it again. The Nasdaq's up 1%. I said this at the top of the show. If we had an 18 basis point move on a 2-year, and I asked you to guess where the Nasdaq was, I don't think you'd say down a couple of tenths of 1%. That was yesterday. Today, yields are higher again by 5 basis points at the front end, back to 3.1%. The Nasdaq's up by more than 1%. What are you learning about this price action, the resilience of this market in the face of what's going on?
So I will say that when I dig down into the tech and growth-oriented sectors in particular, I feel perhaps a little bit better. So we look at tech in particular, it's fueling some of these really, really strong beat rates that we're seeing, at least on my work, which was through Friday. It was the best sector on earnings beats. So I think perhaps just some confidence being instilled by the fact that the quarter was so strong. But I will say, John, when we look at the rate of upward revisions in technology, even if the numbers haven't been cut enough in dollar terms, what we are seeing is that basically nobody has been taking numbers up. So the rate of upward revisions is about as low as it tends to get. We're seeing that as well for things like communication services. Now, what that is, that's a gauge of earnings sentiment and how people feel. So perhaps in that tech complex in particular, just the sentiment got so lousy, it's allowing us to really just rally on what's already happened and the idea that a lot of pain is already understood to be coming. I feel like I'm stretching a little bit there, but that is what I think may be sort of fueling this, kind of move in tech. And we do like the valuations in tech. So, I'll take this as a win and not be too greedy.
Laurie, I know you follow the earnings calls as well. Bank of America does too. I'll share with you what I learned from Bank of America, and then you share with us what you're learning from the work you're doing. I read this quote yesterday in their report. It said the consumer's being squeezed by inflation. 40% of Americans are reportedly having difficulty paying their expenses, above the 38% peak during COVID, according to a census survey. Then they monitor the calls. The earnings calls. Mentions of weak demand spiked to the highest level since COVID, with record weakness in consumer discretionary demand. So I'm reading through that. So I go to the chart of S&P 500 consumer discretionary. We're up almost 24% from the June lows. Laurie, what do you make of that rally in consumer discretionary? That is a monster rally from the June low.
Look, I think if you go back and look at that June 16th low for the consumer discretionary sector, it was the decline that we had seen in that sector since the early January market highs was pretty much in line with the average recession drawdown that you do typically see in the consumer discretionary sector. Now, that sector's changed composition a little bit over time. There's more internet stuff in there now than there used to be. But I think a fair argument could have been made that we saw recession essentially baked in at that June 19th low from the perspective of the price performance itself. I do know that when we look through some of the industry revision indicators, things like specialty retail, internet retail, we're similar to what I was just describing for tech before. We are seeing sort of record low type rates of upward revisions there. So perhaps just the sentiment got so bad in that particular space, it allowed that rebound. And I'll tell you, John, I know you and I have talked about this before, but as I've talked to investors the last couple months, it's become crystal clear to me that everybody's got plenty of defense in their portfolio, whether it's high quality, free cash flow story, consumer staples, whatever they wanted to do to play defense, they've got plenty of it. And I think investors have really been worried about what they need to be exposed to in the recovery trade because they know they don't have enough of it. And that's typically where active managers do underperform in recessions, is when the market turns around.
How much more of that do you think we'll see? You know, nothing changes sentiment like price, and price is moving pretty quickly, and I wonder how quickly sentiment follows. I brought up a quote from BNP Paribas earlier this morning, and they talked about this concept of crowding in. Laurie, what do you make of that?
I think that's a fair point. I haven't read that particular piece, but I do think the momentum will start to feed on itself. It's interesting, John, as I was talking to small cap investors last week, we were talking about the parts of that area of the market that look most compelling. And one of the things I talked about was small cap consumer discretionary stocks, which are more pure plays on the domestic economy than the bigger caps, are actually trading at historical lows relative to the broader Russell 2000. So basically at trough relative valuation multiples. And that was something that I found a lot of investors didn't really realize was in place. They felt pretty lousy about the space. They felt pretty lousy about the idea of investing in consumer stocks with a recession around horizon. But when I pointed that stat out, that perked some people up and got them to look at a space that they hadn't wanted to look at for quite some time. So I think if nothing else, that price action just can force people to kind of sharpen their pencils, go back to the drawing board and do some additional work.
We're doing that right now. The S&P up 0.8%, the Nasdaq up by 1.2. Laurie, if I dialed 1-800-CALVACINA and asked you for your favorite trade right now, US versus non-US, growth versus value, large versus small, what would you say back?
By a mile, it's the small cap stocks. I've covered that space a long time, John. I call it my first professional child. And it is crystal clear to me that that part of the market is baking in recession already. If you look at how it trades relative to jobless claims, the Russell 2000 jobless claims year over year move very, very closely together. The damage that's been seen in the Russell 2000 over the past year is commensurate with a big spike in jobless claims already. The move in small versus large tracks ISM manufacturing. That small versus large trade collapsed over the last year and is already baking in a plunge in ISM manufacturing to typical trough levels. And part of the small cap 101 playbook, John, is that when the unemployment rate starts to tick up in the middle of recession, that is when you want to buy. Historically, that is when we have started to see small caps turn around in the middle of a recession. So I understand that nobody wants to see job losses, but there is a consensus that they are coming. And if that consensus is right, that is going to be the trigger to get this small cap trade turned back around.
I hope the actual children aren't listening to those comments about small caps. Laurie, it's good to hear from you. As always, Laurie Calvacina of RBC. There's a rip-roaring rally for you on the S&P, up 0.75%, up another 1% or so on the Nasdaq, even as the Fed continues to push back with the Fed speak over the last 24 hours. We need to talk about crude as well. Coming up, OPEC Plus agreeing to the smallest production hike in its history. More on that from the Bloomberg team and the latest from the White House up next.
We are calling on, whether it's OPEC or it's here at home, to increase production when possible and at the degree that is necessary to keep these prices coming down. This is not focused on OPEC. This is a global issue. They do have the capacity to increase. There's no doubt about that. We will continue to have the same message, whether it's a sovereign or if it's a private company.
Fantastic to catch up with Amos Hochstein there, the State Department's senior advisor for energy security. We caught up with him just moments ago after OPEC Plus delivered the smallest increase to output in its history, just 100,000 barrels a day. Joining us now is the Bloomberg team. Anne-Marie down in D.C. Julian Lee joined us too. AMH, you heard what he said there about that meeting with the Crown Prince. He said it wasn't all about oil, it was about other important things.
Yeah, it certainly was. Obviously, everyone's going to point to oil because when Russia invaded Ukraine, energy prices spiked. That was really a tectonic shift for this White House to really start re-engaging on a deeper level with the kingdom, and that really pushed the president to make that trip. But there's a number of issues at play: climate, investment. Yesterday, Jonathan, we had a 2-month truce extended in Yemen. These are all really important factors. Also, the United States yesterday approved missile sales, needs to go through Congress still, but approval of Patriots to Saudi Arabia, approval of other missiles to the UAE, a number of discussions. And I think one thing the White House wants to make clear, yes, this is tiny. I have covered OPEC before, not as long as Julian Lee, but I've covered it for years. 100,000 barrels a day is very, very small. It's symbolic and it's token. But what the White House wants to show is that the past 2 months, there's also been some goodwill from the group, increasing capacity. What they're looking at is the direction of prices. What the president has tweeted this morning is the fact that a majority of gasoline stations now are actually selling gasoline under $4 a barrel. That's the price that matters to this White House.
Julian Lee's right with us right now. Julian, we can make this political. We can make this about geopolitics and foreign policy. BTIG called it the foreign policy equivalent of a slap in the face. The administration's pushing back against that. I think what we've got to focus on is spare capacity within OPEC. Julian, how much spare capacity is there actually? And what does this decision this morning actually speak to?
I think there's relatively little spare capacity. I mean, you know, the spare capacity, I think, exists within Saudi Arabia and the United Arab Emirates. I don't think there's anything very much anywhere else. Saudi Arabia may have 1 million barrels a day or so. The United Arab Emirates may have about half of that, maybe a little bit more than half of that. But that's probably it. And if you look at the OPEC Plus group as a whole, in June, and that's the most recent month that we've got complete figures for, they were pumping about 2.8 million barrels a day below their target. So there's a lot of oil that is there in theory, but isn't actually there in practice.
So, Gillian, I think this gets to the big important issue right now. Just how fragile is the supply backdrop going to be through the next year or so? We've really aggressively taken down the SPR to attack oil prices. Yep. You've got OPEC telling us that they've got issues with spare capacity. Gillian, what does this mean for price going forward?
I think it means that prices are going to stay very volatile. I mean, you know, what we've seen happening in the last 2 to 3 weeks, we've seen Libyan production, which had been hit hard by, again, civil unrest in the country. That's started to come back. So we've had maybe 500,000 barrels a day, maybe even more than that, added by Libya in the last 2 to 3 weeks. That's a significant increase. But Libya's production, I think, rests on some fairly shaky foundations, and that is the country holding together and these two rival governments being able to sort of negotiate the frictions between them. So, you know, I'd be worried about Libya being able to sustain production at its current level of about 1.2 million barrels a day. There's not a lot of spare capacity elsewhere. We've got EU sanctions on Russia that are due to come into effect in early December. I still have huge reservations about how a price cap is actually going to work and whether Russia would agree to sell under those terms.
I'm with you. Gillian Lee, thank you. And a special shout out to my good friend AMH down in DC as well, who works about 10 times harder than I do to make those interviews happen. Anne-Marie, thank you. Down in Washington. I want to get you some economic data. We can do that right now with Mike McKee. Mike McKee, it's almost an appetizer for the big one in about 9 minutes.
It is an appetizer, and it's going to worry some people in the markets. Remember last week when we got the S&P manufacturing numbers, we saw a big drop in the markets. We've seen the S&P 500 fall, but not a real reaction in the bond market to services PMI from S&P Global. Falls, actually rises to 47.3 from 47, but the global composite stays under 50 as well at 47.7. Both of those just a little tick higher, but both in contraction territory. Now, that sets us up, as you mentioned, for the ISM Services Index. We are expecting a small drop there to 53.5 from 55.3. Still positive, but everybody's also going to want to see what happens with prices paid after the ISM Manufacturing Index fell 18.5 points, one of the biggest drops ever in that index.
Mike, you're better at this than me. What's the difference between those two things, S&P Global, ISM? Different weightings, what is it?
The ISM numbers generally are large multinational corporations, and the S&P numbers look at a series of companies in different sizes of the industries. So they're a little bit different in their subsets. The S&P numbers are a little bit, surveys a few more businesses as well.
Mike McKee, thank you, sir. I knew you'd know. I knew you knew, rather. I knew you'd know. Mike McKee, thank you. Mike's going to break down that data for you in about 7 minutes' time. We'll do that with Guy Johnson and I believe Alex Steele at the top of the hour. That conversation just around the corner. Payrolls too. 250,000 is the estimate. Mike's going to break this all down for you on Friday. That's the median estimate in our survey. The high is 320, the low is 50K. Once you get through that and all the Fed speak, then it's on to next week. CPI Wednesday next week, August 10th. We're looking for headline to come back in, but ultimately for core to remain elevated. And you know the story, the front page of the paper will go with the headline year-over-year figure. On Wall Street, it's about month-over-month core, trying to gauge how sticky the inflation story and ultimately how sticky it is and how much more work the Fed's got to do. Coming up, your trading diary. That's coming up next. This is Bloomberg. The Nasdaq 100 is almost 18% higher than its June low, and it's still rallying right now, up more than 1% on the Nasdaq, up 1.4%. On the S&P 500, up 0.8%. What's interesting about this part of the session, about 25 minutes in, like yesterday, is how resilient the equity market is in the face of what's happening with this bond market. 2s, 10s and 30s look like this. Yesterday, 2s up 18 basis points. Stock market down a couple of 0.1% on the Nasdaq. Today, up 4 or 5 basis points, and the stock market on the Nasdaq absolutely ripping. Something to think about. That's the price action. Here's your trading diary. Coming up at the top of the hour, ISM services data. Then we'll hear from the president at 2 p.m. Eastern time. Fed officials throughout the day. Harker Barkin, Daily, Kashkari, all on the agenda. Bank of England rate decision and jobless claims tomorrow morning. Looking forward to that. Then we round out the week with payrolls Friday. That does it for me. I'll see you tomorrow morning. Thank you very much for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.